Nvidia isn't just going to $300, it's going to $300 this year, and the market is still missing the biggest reason why. The implications for your portfolio, especially if you're holding any AI names, are massive. We're unpacking that today, plus why some Canadian banks are shrugging off a flat TSX, and a big payment processor making a quiet move. The third story. It's a number nobody's printed yet. InvestIq. Let's get into it. The market loves to call Nvidia overvalued, especially after its incredible run. Today, the S&P 500 is down a hair, 0.17%, and even the TSX is flat at minus 0.08%. You'd think this would put pressure on the AI darlings. But look closer. Nvidia is holding firm. The conventional wisdom is that the hyperscalers, Google, Microsoft, Amazon, have already bought all the GPUs they need, and that growth is about to normalize. That thinking is dead wrong, and it misses the fundamental shift happening in enterprise AI adoption. Let's start with context. The first wave of AI demand was indeed driven by those tech giants building massive foundational models. They needed unprecedented compute power, and Nvidia's Hopper architecture delivered. Now, we're entering the second wave. Every major enterprise, from banking to healthcare to manufacturing, is scrambling to integrate AI into their operations. This isn't about building ChatGPT from scratch, it's about deploying AI for internal efficiencies, customer service, data analysis, and product development. Think custom models, fine-tuned for specific business problems. These aren't the multi-billion-dollar orders from a handful of companies. These are thousands of smaller, but cumulatively massive, orders from the rest of the Fortune 500, and beyond. The data backs this up. While the initial surge from hyperscalers might slow its rate of acceleration, the absolute volume of demand from the broader enterprise sector is just beginning. Nvidia's Q2 2026 earnings, which blew past expectations, showed strong revenue diversification beyond their top 10 customers. We're seeing a significant uptick in demand for their full-stack solutions, not just the raw silicon. It's the CUDA ecosystem, the software, the networking, the entire platform, that's becoming indispensable. This isn't just about the current Hopper generation either. The Blackwell architecture, still rolling out, is seeing pre-orders that suggest this enterprise adoption isn't just a flash in the pan. We're talking about a multi-year refresh cycle that's only just starting. Now, let's look at the evidence. Consider Broadcom today, down 5.94%. Broadcom is a key player in data center networking and custom AI chips. Their dip today, while not directly related to Nvidia's core GPU business, highlights a common misconception that all AI-related chip demand moves in lockstep. Broadcom's issues are often more tied to specific networking cycles or custom ASIC design wins, which can be lumpy. Nvidia, by contrast, benefits from a much broader, more resilient demand curve for its general-purpose AI compute. They're selling the picks and shovels to everyone digging for AI gold, not just a few specific prospectors. Think about the Canadian context. Our banks, like Royal Bank and TD, are up today, plus 0.42% and plus 0.6% respectively, despite the flat TSX. Why? Because they're investing heavily in AI themselves. They're not buying 10,000 H100s, but they are deploying AI for fraud detection, personalized banking, and risk management. This isn't a speculative bet for them, it's a necessity to remain competitive. Multiply this across every major industry globally, and you start to understand the sheer scale of the demand coming for Nvidia. The market is still valuing Nvidia largely on hyperscaler spending cycles, but the real story is the millions of enterprises globally that must adopt AI to survive. And they're all coming to Nvidia. This leads us to the prediction, and the number nobody's printed. The market's biggest blind spot for Nvidia is underestimating the sticky, persistent nature of enterprise AI adoption. It's not a one-time purchase, it's an ongoing investment in compute infrastructure that will require regular upgrades and expansions. Nvidia's leadership in both hardware and software means they capture a disproportionate share of this spend. The counterargument, of course, is that competition will eventually catch up, or that custom silicon from the hyperscalers themselves will erode Nvidia's dominance. That's a fair point, but it misses the current reality. Nvidia isn't just selling chips, they're selling an ecosystem. The CUDA platform, the developer community, the sheer breadth of software optimization for their GPUs, it's a moat that will take years, if not a decade, for competitors to meaningfully challenge. Custom silicon from hyperscalers addresses a sliver of their own specific needs, but doesn't solve the broader enterprise problem of easily deployable, scalable AI. My prediction is this: Nvidia will hit $300 before the end of 2026. This isn't based on some speculative valuation multiple, but on the relentless, underestimated demand from the vast enterprise sector for their Hopper and Blackwell architectures. We're not talking about hypergrowth rates forever, but a persistent, strong growth trajectory that current valuations simply haven't baked in. And while we're talking about quiet moves, keep an eye on PayPal. PayPal is up 1.77% today, a modest move, but significant for a mature payment processor. Why? They're quietly integrating AI into their fraud detection and customer service, too. It's a perfect example of that enterprise adoption I'm talking about, just at a different scale. Even Bitcoin and XRP, relatively flat today at plus 0.02% and plus 0.27% respectively, reflect a market taking a breather, but the underlying AI currents are still flowing strong. The takeaway for you is this: differentiate between the short-term noise and the long-term structural shift. Nvidia's growth story is evolving from hyperscaler-driven to enterprise-driven, and that's a much deeper, more sustainable well of demand. Don't get caught up in the overvalued narrative when the fundamental drivers are still accelerating. That's the InvestIq take for today. Analysis only, not financial advice. That's the InvestIq take for today. Analysis only, not financial advice.